minus 5.81%. Yeah, that is the massive, brutal, and sudden collapse we literally just witnessed in the Korean stock market. If you were watching those tickers flash red, you honestly might have thought the sky was falling. But hey, I'm here with our super cute data crunching mascot, Loro, to look right past all that panic. We're going to break down the exact fast-moving mechanics that actually triggered this plunge. It's urgent, it's analytical, and the real story, well, it's hidden deep in the market's plumbing. Let's dive in. So, on the surface, a severe 5.8% plummet in the KOSPI index looks like your absolute textbook market crash, right? Capital fleeing, investors panicking, the whole shebang. But as Loro peels back the layers of this specific trading session, we uncover a totally different mechanical anatomy. Actually, scratch that. It wasn't a sudden hatred for Korean tech at all. It was more like a perfect storm of settlement rules, macro pressures, and an entirely empty tank of short sellers just waiting to reload. I mean, the sheer scale of the carnage was breathtaking. Just picture an absolute sea of red across the market. The index hit an intraday low of 8,126, which is a staggering 9% decline at its worst point. Heavyweight tech names were literally bleeding out, and they dragged the entire index down with them. But to figure out why the selling pressure was so relentless, we really have to look at what happened just hours before the bottom fell out. Okay, so right before this crash, we had a massive rally. Driven by Micron's $100 billion revenue outlook and SK Hynix's ADR offering, we saw aggressive short covering. The total KOSPI short selling balance rapidly plummeted from almost 19.5 trillion won all the way down to just 2.76 trillion. By June 26, it was hovering near absolute zero. So what does this all mean? Well, an empty short balance basically means the door was wide open for massive fresh short entries. The market was left completely exposed. Now, combine that vulnerability with Korea's rigid settlement mechanics. Trades take 2 days to settle, the whole T+2 rule. Since trades executed on June 26th officially settle on June 30th, which happens to be the half-year end date, a trap was basically set. Foreign investors had grown super overweight in Korean semiconductors during the recent rally. Facing immense structural pressure to reduce risk for the half-year mark, they were mechanically forced to dump their positions. June 26th was literally their absolute last day to do it. And when they did, targeted, fresh short selling mercilessly hammered the absolute crown jewels of the KOSPI, SK Hynix and Samsung Electronics. SK Hynix absorbed a massive 1 trillion won in short selling, dropping over 8%. Samsung took a hit of over 866 billion won, falling 5.3%. Get this, together, these two stocks made up nearly half of all KOSPI short-selling volume. And when SK Hynix fell, it dragged down SK Square by over 9% too. Just those three stocks accounted for nearly 75% of the total KOSPI index decline. Crazy, right? Once those heavyweights started falling, a vicious, systematic feedback loop kicked into high gear. It was a total cascade. Prices drop, portfolio risk limits are instantly breached, and boom, automated trading bots flood the market with programmed sell orders. This entirely mechanical, machine-driven reaction flushed out a staggering 2.57 trillion won in outflows, which just sent prices spiraling even lower. The volatility got so extreme that market circuit breakers actually had to step in. At 11:12 a.m., a sidecar protocol was triggered, forcing a temporary 5-minute pause on all automated program selling. But honestly, it wasn't enough. By 12:10 p.m., a super rare level 1 circuit breaker halted all trading across the entire exchange for 20 whole minutes after the index blew past an 8% decline. To put that into perspective, this was only the 5th activation of 2026 and the 11th in the entire history of the exchange. But we can't just look at local mechanics. We really have to zoom out and look at the macro headwinds too. The surging US dollar acted like a massive accelerant here. Driven by the Federal Reserve's median projection of 3.8% and a 67% probability of a September rate hike, plus all that rising safe haven demand, the dollar just surged. This pushed the won to 1,537.4 against the dollar, hitting levels we absolutely haven't seen since early June. And this currency dynamic has severe real-world impacts. A rapidly weakening won sharply reduces the appeal of holding Korean assets. So foreign investors, who were already sweating those T+2 pressures, intensified their liquidation. As they sold off equities and converted won back to US dollars, they generated even more won weakness. It's this brutal dual pressure system that forced capital liquidation way beyond just the tech sector, bleeding into construction, securities, and power infrastructure. There was also a secondary, fundamental ripple effect hitting the market at the same time. Overnight, Apple announced dramatic price hikes of 15 to 25% on Mac and iPad products, citing memory supply depletion and AI data center costs. This immediately raised the risk of consumer demand destruction. Because of this, non-HBM supply chain stocks got absolutely crushed. LG Display, which supplies panels for these devices, faced a direct threat to its order volume and dropped over 6%, with short sellers aggressively piling on.
But right in the middle of this absolute bloodbath, there was a hidden plot twist, a major canary in the coal mine, if you will. A report surfaced detailing Samsung Group's massive master plan, a 1,000 trillion won investment over the next decade. For context, that's roughly $650 billion US dollars. Spanning semiconductor fabrication, AI infrastructure, and secondary batteries, this enormous capital expenditure strongly signals a tidal wave of future domestic equipment orders.
And the market, it reacted to this hidden signal immediately. While the large-cap manufacturers were crashing under the immense weight of settlement rules and short selling, foreign capital was actively rotating into KOSDAQ semiconductor equipment suppliers. PSK Holdings shot up over 10%, and Test jumped double digits too. Capital didn't just flee the country, it simply rotated out of large caps, taking short-term profits, and went straight into long-term bets on the equipment layer.
Which brings us to the ultimate proof that this was definitely not a structural panic. While foreign and domestic institutions were aggressively selling cash equities, they simultaneously held massive net long positions in KSPI 200 index futures. Foreigners held 89.1 billion won net long, and domestic institutions held 587 billion won net long. Think about it. If you genuinely believe a market is crashing, you sell equities and you short the futures. Holding long futures proves they are secretly retaining bullish exposure.
So, what does this all mean? Was this a systemic crash or just a mechanical rotation? Well, the evidence firmly points to a mechanical adjustment. Forced half-year settlements, depleted short balances, inviting a tactical strike, and a strong US dollar created a localized flush. Capital did not flee Korea. With massive investments on the horizon and futures positioned long, the underlying bullish thesis is still perfectly intact. So the real question isn't why the market dropped, it's who is quietly buying the dip while everyone else panics.
If you would like to receive news on the closing of Asian stock markets before the New York stock market opens, please subscribe.